So welcome to those who've joined already. We're just going to give it a minute to let the numbers come up, and then we'll get started. Okay, welcome everyone. Let's get cracking. My name is Alex Walgar. I'm a partner at Mills & Reeve, joined today by Margaret Savory and Helen Farmer, both at James Cowper Creston, who are respectively IP experts in the tax and accounting sphere. I'm a lawyer by background. We're going to spend about 35 minutes of the 45 minutes today giving a bit of an overview of some of the key commercial, legal, accounting and tax considerations in the context of an IP strategy. Necessarily because we've only got 35 minutes, it's going to be relatively high level, and I appreciate there'll be a range of experience on the webinar today. So if you do have any specific questions as we go through, please do pop them in the Q&A chat, and we'll try and answer them either as we go through or at the end, and if there isn't time, we'll follow up afterwards. So without further ado, I will get cracking with my section, which is a bit of an intro to IP strategy, the why, the what, the how. Although I'm a lawyer by background, I've worked with quite a number of businesses on defining their IP strategies or updating them, from early stage sort of tech companies right the way through to global FMCGs and banks. So I've seen quite a range of strategies and contexts, and just hoping to share a few tips in the next 15 minutes or so. So why have an IP strategy? Well, you'll have seen lots of statistics, I'm sure, about intangible value and the fact that it's growing as both in absolute and proportional terms over time. Here we've got a good stat from Brand Finance, which suggests that global intangible value is up 8% year on year last year to $1.9 trillion, which is approximately the GDP of the US, to put it into context, and a 29% increase over 25 years in the share of investment in intangibles as a class compared to other types of assets. So clearly intangibles are increasingly important globally, and specifically in the context of corporate and organizational strategies too. So it's only sensible to have a strategic approach to IP, in the same way as companies try to adopt a strategy that then makes execution better and simpler. So too, you can do that in relation to your innovation and the intangible assets, the IP that results. So critical things about IP strategy that can provide benefits. Let's go back for a second. So it's informed by and supports the organization's goals or strategy. That's really important. You need to start with where the organization is situated, where it wants to go to, and then how IP can play a part in that, and indeed vice versa. It becomes quite reciprocal when done well, which is nice. It allows you to make decisions strategically about where to invest your resource and time to maximize return on investment, and be clear-eyed about that. Linked to that, it can allow for systematization, and then also allows you to identify where risks in relation to intangible assets may be, and limit the value that is leaked from the organization. So it brings benefits of tangible value. Investors typically like to see IP strategies that are sophisticated and evolve over time. And also some investors are particularly keen to see certain types of IP assets being held by certain types of business. We'll come on to that a bit later. And it can improve the exit value if it's a business that is looking to go public or exit via a trade sale in the long run. And then also there's the intangible value beyond the value of the intangible assets that's delivered. Having an IP strategy can get people behind what they're trying to do in an innovation context. It can lead to enthusiasm, it can lead to attention from senior stakeholders, which can improve budgets and so on, and just a general buzz that an organization is going somewhere and developing intangible assets. Okay, moving on. What is an IP strategy? Well, I've seen all manner of approaches to IP strategy, some better, some worse. I think the critical point is that it should be appropriate for the level in which it appears in the organizational matrix. So it's linked to and informed by the innovation strategy, which in turn is part of the organizational strategy. So you need to think about the particular context of the organization, where it is, where it wants to go, the particular market dynamics that might be relevant when defining the IP strategy. An IP strategy itself should ideally be relatively short. We'll come on to that in a minute. And it sets out a vision for IP and then the particular focus areas where you will allocate time, resource, and so on. Ultimately, the audience that it's for are people who don't have as much IP experience as you might, and that might be in other parts of the business, or it might be senior management. So it's important to be easily understandable, and then it translates down ideally into an IP framework, and that's the sort of more detailed document that records the systems, the tools, the processes, responsibilities, and the KPIs that you're looking to achieve to support the strategic priorities in the IP strategy. So that's where you get into the real specifics. But having both documents interrelating to each other and informing each other and evolving over time is ideally the way that you go about it. Moving on. So what doesn't good IP strategy look like? Well, I'll say up front that I've got a template IP strategy that I'd be happy to share if anyone wants to email me afterwards, and I will send it over in case you're thinking about updating or evolving or putting a strategy in place for the first time. But here are some general tips. As I mentioned earlier, what are your stakeholders? What do they really care about? Is critical to hold in mind. They care about the organization achieving its commercial objectives. So the IP strategy has to be framed in supporting the achievement of those commercial goals. That's the first thing. So we link to that. It can't be about IP for its own sake. It's got to, it's not a strategy to say we want to file a lot of patents, but it might be a strategy to say we want to file a lot of patents in these specific areas that we know are going to be important for our organization over the next 10 years. And also other large companies or larger companies are looking at these areas. That's a more strategic way of looking at it. Linked to that, it's going to be tailored to the stage a company or organization is at, early stage versus mature, and market that it's in, and the sector that it's in, and then wider context in terms of budgetary constraints, economic situation in a country or set of countries if it's an international business. They're all relevant. Ideally, it draws on examples and best practice. It's usually more readily understandable if you're able to say, well, X company has done it this way and we think that's good, but we're going to evolve it in this following way. Usually that helps with buy-in. It needs to be clear about what needs to be achieved and how to assess return on investment, but it doesn't necessarily have to give the answers in terms of what the calculations will be. That's more for a framework, and certainly within a framework you can end up with quite sophisticated calculations which allow you to figure out the value of intangible assets and how they map onto products and services. So that allows you then to be a bit more granular about how you make decisions. I've said vision is infinite, influenced by Simon Sinek, in the sense of, in the same way as a good corporate vision ideally is infinite and never is finished, so to an IP strategy, it starts with a point of we're going to, for example, achieve excellence in partnering with third-party organizations selectively and maintaining our own proprietary interests in these ways. That is infinite in the sense of it can be executed indefinitely, but the strategy then, the specifics of it should evolve over time and be reviewed maybe on a 5-yearly basis. As I say, it defines what needs to be prioritized and encoded in the more detailed framework. That helps to support systematization, perhaps reducing wasted time if you know, and generally if you have an idea of the strategic priorities you're going to focus on, you can allocate internal resource to the knotty issues, and over time hopefully rely less on expensive external advisors such as ourselves in this call. And it needs to be short, 2 or 3 pages ideally. It's a challenge, but if you can do it, in my experience, that's a much better strategy than a much longer one. So moving on, just a few thoughts in the next 5 minutes over some of the parameters that you might see in IP strategies and where perhaps legal or commercial pitfalls and possibilities might arise. So one of the big questions usually in an innovation strategy that then has to be answered also in the IP strategy is getting where you want to go. Are you going to buy in technology? Are you going to build it yourself, or are you going to partner with others to do that? And the IP strategy needs to reflect the options that you've selected and potentially differentiate between different forms of innovation and collaboration. It also needs to take into account the fact that even if the contracting position is well thought through, there are still practical risks to exposing your IP to the world if it's, for example, a trade secret, confidential know-how. So you need to think about the practicalities of how you will select partners and work with them and the hygiene around that too. You need to think also more broadly about dependency on others. A lot of AI organizations are currently building all manner of exciting models on the basis of ChatGPT's underlying LLM, which is great, but obviously there's a high degree of dependency of business models on ChatGPT. So you have to think about that in the context of a strategy and the alternatives that you might then be able to explore over time, bearing in mind that you might be captive to an increasingly powerful organization. And I've put open source software on here as well, simply because it's a growing risk from an IP perspective, I would say, and pretty much every code base has some, in fact, in many cases, a majority of open source software within it. So you need to think quite carefully about how you factor that into the risk governance processes that you have to avoid copyleft scenarios and potentially tainted code in other ways. Do you really want or need a patent? Commonly, the conversation about IP strategy starts when you're thinking about filing your first patent. There are good reasons to do that, not least tax, which we'll come on to, but also in some cases it's not preferable. Some patents are difficult to get in some areas, like computer implemented inventions, although there is a difference between the US and Europe in that respect. And having a something protected as a trade secret instead can be more beneficial, because then there's no publishing of the information that ultimately makes up the patent, risking potentially not actually ending up with the patent and also exposing the trade secret. So adopting a structured approach to deciding between patents and other forms of protection, 5 or 6 parameters that I commonly use, is usually quite a good idea. You see people forgetting other IP rights far too often. Designs are a particularly unloved IP right, but actually can coexist with patents. For example, recently filed designs for a client that also had a patent, was seeking a patent over a particular graphical user interface, which was quite unique. And that was effectively much quicker form of protection, and a registered design gives you 25 years plus it gives you a monopoly right, and copying is not necessary. You also see organizations, particularly mature ones, hanging on to legacy IP rights for far longer than they should and incurring significant renewal fees in doing so. So systematizing that decision-making process and trying to take emotion out of it's quite important. Some companies choose to do freedom to operate searches routinely. They can be useful also for competitor intelligence, as well as thinking about the risk of launching and potential patent infringement. Others choose for sometimes pretty good reasons, particularly not wanting to be exposed to awareness of potential infringement and therefore potentially higher damages awards in the US and other jurisdictions in the case of infringement. So it's a balance and you have to think that one through. When you come to the IP framework and starting to cascade that through policies, you have to be careful not to suppress an innovation culture. For example, software engineers rather like contributing to their open source projects, so you need to make sure that you're not stopping them from doing something that they feel is important to build their own CV and experience, for example. Open innovation is an interesting and growing area. some organizations, I think Tesla's often cited as a good example, have decided to make available vast swathes of their IP on an open basis, but it's not open in the truest sense because they are subject to quite significant license restrictions, including they're not suing Tesla for infringement of your patents. So it's cuts both ways, and it's an intelligent approach. And networks too. So if, for example, in the financial services industry, LOT is a innovation network of various organizations, and they have come together to basically form a patent pool, which means that if then a patent troll comes after one of them, they have a series of patents that can be counter-asserted against those patent trolls, and that's quite effective as a collective form of defense, sort of NATO of the patent world. KPIs, you've got to be careful if, for example, you're setting KPI over the number of patent filings, that quantity doesn't trump quality, particularly if you're offering financial or cultural incentives to the individuals who are the inventors of the patent applications. In terms of data, I think the key point there is there's a hodgepodge of IP rights that protect data. It's often difficult to be specific on which one in which circumstance. So you really need to get your contracting right in relation to data, particularly if new data is going to be created. You need to understand who's going to have access and control, both during the life of the contract and afterwards. And that's something that I see not done well quite a lot. Structuring. Some companies get quite excited about structuring their IP, for example, putting their IP in a holding company, potentially with a view to insulating licensing risk in terms of licensing it out, but also in terms of maybe thinking about white labeling or potentially even splitting off IP in future. That's fine, but obviously it takes this complexity. There can be tax implications, particularly if you're doing it cross-border, and also you end up, when you're starting to move IP around a lot, in the realm of legal fiction. So you see split legal and economic or beneficial ownership of IP quite a lot. That doesn't really work under English law. What you really have is a license between the legal owner and the beneficial owner, but that's not how it's recorded in the document often. And there are implications in terms of making sure that you actually then register the license as well for enforceability, and thinking about which party ultimately, which if even within the group structure, is entitled to recover damages, can be quite important. And I've seen companies trip up on that in their group structuring in the past. And finally, don't forget the potentially significant tax incentives of filing IP, and more generally in and around innovation. And with that, I think probably a perfect segue over to Hella to talk a bit about accounting before Margaret.
Thank you, Alex. So I'm a senior manager in the accounts and advisory team at James Cooper Creston, and I manage a portfolio of technology and life science clients. I'm going to spend the next 5 to 10 minutes covering IP strategy in reference to reporting in the financial statements. So the accounting of IP is a topic that I regularly discuss with my clients, either at their financial year end or as a separate advisory piece. The kind of accounting choice for IP is whether to recognise expenditure of intangibles as an asset on the balance sheet, subject to certain criteria, or to expense the cost to the profit and loss account. So the result of this choice is either that there's an asset recognised on the balance sheet, which will reduce in value over its deemed economic life, or all of the expenditure is taken directly into the profit and loss account in the period in which it was incurred. Therefore, arguably, and from solely a presentational standpoint, the choice is one of timing. And one reason that I've seen from my clients for capitalising the spend is to more accurately capture the value spent on creating that IP. In reference to the accounting mechanics, I'll focus on the treatment of intangible assets in accordance with Financial Reporting Standard 102. And this is the accounting standard under which most of our clients prepare their accounts, certainly within my team in accounts and advisory. If accounting under international financial reporting standards, the treatment and criteria may differ, and it would be prudent to seek advice from your accountant. So section 18 of FRS 102, which is the financial reporting standard, the core definition of an intangible asset is identifiable non-monetary asset without physical substance. Now, an asset is identifiable when it's separable, so that is that it can be separated from the entity and either sold, transferred, licensed, etc., or it arises from contractual or legal rights. If the IP therefore meets the definition of an intangible asset, the next thing to be considered is how to recognise the value of the asset. And the principle for the recognition of such assets is initially at cost, if both probable future economic benefits will flow into the entity and the cost or value can be measured reliably. So by nature, there'll inevitably be a level of uncertainty to future economic benefits. However, the key word here is probable, in the probable future economic benefits. And for economic benefits to flow, there must, of course, exist a market for the product. Now, thinking about how to measure the cost, particularly in respect of internally generated intangible assets, the entity must differentiate the spend between the research phase and the development phase. So expenditure on research cannot be capitalized as an asset, and it's instead recognized as an expense when incurred. And examples of spend within the research phase include activities aimed at obtaining new knowledge and the search for alternatives, be it materials, devices, or products. In respect of the development phase, there are 6 conditions to be met for that spend to be capitalized. The first is the technical feasibility of completing the asset for it to be available for use or for sale. The second is the intention to complete the asset. The third is the ability to use or sell the asset. The fourth one is how the asset will generate the future economic benefit. So again, the existence of a market or usefulness. The fifth one is adequate resources to complete the development. And finally, the ability to reliably measure the attributable expenditure. So examples of those within development phase are the design, construction and testing of prototypes, tools, jigs and molds involving new technology. Companies must therefore consider and document, importantly, that all the criteria have been met in capitalising such development expenditure. In my experience, a significant proportion of development expenditure is staff costs, being relevant staff time spent on developing the technology or the product. Once capitalised, the subsequent measurement is either under the cost or the revaluation model. So under the cost, it's the cost less accumulated amortization or impairment. Now, amortization is a charge against the asset, which reduces the value with a corresponding entry flowing to the profit and loss account as an expense. And this amortization only begins when the asset is available for use. And it's a systematic basis over the useful life. If unable to make a reliable estimate, then the life cannot exceed 10 years. So it's either the 10 years or an estimate. And it's over generally a straight line method is most likely. The revaluation model is similar in that the assets carried at a revalued amount, being fair value in reference to an active market, which is inevitably more difficult to substantiate with new technologies and products. In summary, IP can be accounted for as an intangible asset where the expenditure meets the relevant criteria. The intangible asset will reflect the value of the generation of that asset on the company's balance sheet. And I'll now pass over to Margaret Savory for our business tax team.
Thank you, Hella. Hello, my name's Margaret Savory, and I'm a corporate tax specialist at James Cooper Creston. And like Hella, I work with a lot of spin-out and early-stage tech and biotech startups. So the first thing I want to talk about from a tax perspective is the attractiveness as the UK for holding your intangible assets. Our current tax rate oscillates between 25% or down to 19% if you have taxable profits below £250,000. This sits pretty much in the worldwide average, which is currently 23.45%, ranging from Puerto Rico with a high of 37.5% and Hungary down at 9%. So that's our main rate of corporation tax. But specifically with reference to IP, we have tax reliefs, and that typically is in the form of allowing the amortization of the intangible asset for tax purposes, and specific incentives, namely patent box and R&D tax relief, both of which I will come on to later. Such is the importance of intangible fixed assets that they have their own bit of the corporation tax legislation. Historically, pre-2002, they were dealt with under the capital gains tax regime, but now there is a specific bit of legislation, the intangible fixed asset regime, in the corporation taxes accounts. Broadly, it's saying follow the accounts. So whatever happens with Hella and team in the accounts, we would follow it for tax purposes. The first two bullet points there just list the tax definition of an intangible fixed asset, which is broadly in line with the accounting definition. And then there's a list of some of the things that are included. I just wanted to draw your attention to HMRC Update Issue 91, which was issued in December 2021. And they list some common errors and mistakes when people account for and do their taxes regarding intangible fixed assets. The first thing is asset identification, and HMRC say it is important to undertake a detailed analysis to support asset identification, both from a tax and legal perspective. The second point is that they only purchase goodwill can be recognised in accordance with accounting principles. So looping back to what Hella was saying. 3, the date of acquisition is important, and you must get evidence to document that date correctly. And again, this is relating to how you can apply the correct tax treatment. They then reiterate the need for an independent valuation of your IP, and this perhaps needs to be done on a regular basis. And finally, document everything. So it's very important as you go and continuously you keep supporting evidence of all your valuations and anything to do with IP. In terms of some of the benefits of our current IP regime, movement of IP is important, and the basic rule is know who you are selling to. If you are within what's called a UK tax group, which is a more narrow definition than the accounting definition of a group, and I've put there that it's 75% direct ownership going down to 51% if it was indirect, but broadly quite a tight group, and they have to be within the UK, then the movement of IP can be what's called tax neutral. So there is no tax charge at the time that the asset is transferred between members of the UK tax group. Instead, the new company will inherit the history. If you're selling to a third party outside the UK tax group or to a related party, the general rule is probably the market value, which is not necessarily the price you pay for it, but there is a market value rule. There is also a thing if you sell at a profit called rollover relief, which mirrors the rollover relief under the capital gains tax regime. And finally, there's some anti-avoidance around these benefits. That is what's known as a degrouping charge, which is if you leave your UK tax group having transferred an asset within 6 years, potentially a charge can come into play. Or again, there are some special reliefs and exemptions from that. And then I've just reminded that related parties, which are perhaps companies that you're connected to, but not within the UK tax group, but say someone that you control, you might need to make sure you do things at the market value, the arm's length principle. Could we have the next slide, please? Just a few other aspects. Typically, if you have IP, there might be royalties or license payments. In the UK, the default is a 20% withholding tax when you have to pay out on royalties of things like brand and patents and copyright. I've crossed out the EU Interest and Royalties Directive, which allowed everything to be paid gross because we are no longer in the EU. That no longer applies. So you have to look at the individual double tax treaties between the relevant country to which you're paying or receiving from said royalties. Related parties, I've mentioned them already, typically companies that you are connected to, so maybe you control 50%. If you pay a royalty to them, but it's accrued and you haven't paid it within 12 months, then you will not get the tax deduction until you pay it. And finally, on VAT, my colleague, I'm not a VAT expert, my colleagues at James Cooper Creston, just to remind you that the default UK rule applies. Payments are standard rated at 20%, but they are subject to the B2B general rule, which is that it's where the customer is located. So if you were to perhaps be charging for a license fee to the USA, that would be considered outside the scope of that. So moving swiftly on, we've got a lot of ground to cover in a short space of time. And R&D tax relief, an awful lot has been written, spoken about in the last couple of years, an awful lot of change going on. This is just meant to be a high level, make you aware. We have at James Cooper Creston prepared a couple of webinars, so you can go onto our website and look at those which detail all the changes if you really want to get into the depth of R&D tax relief. This is merely just to alert you to some of the changes. So at its most basic, you have to be a company within the charge to corporation tax and have qualifying projects. And these are qualifying R&D projects which are defined in the guidelines as to the meaning of science and technology for tax purposes. And basically what you have to have is an advance in science and technology through the resolution of scientific or technological uncertainty. Having got your qualifying projects, you then have to have qualifying expenditure. And broadly on those projects, the qualifying expenditure is staffing costs, consumables, things like reagents, any subcontracted activities if you've used a third party, and maybe some temporary workers. So at present, and that is for accounting periods beginning before the 1st of April 2024. And the key thing is look at the start date of your accounting periods. You have two schemes, the SME scheme for small and medium-sized enterprises and the R&D expenditure or RDEX scheme. So that's currently in play. However, for accounting periods beginning on after the 1st of April 2024, we have a new merged scheme. So we're just coming into the new rules. Do be aware of these. Next slide, please. So very briefly, the current regime, but there are also some important changes. So this is for accounting periods beginning before 1 April 2024. Firstly, and this rule always stands, you've got 2 years to file your R&D claim with your tax return. It's part of your tax return. However, since the 8th of August 2023, you have to, via a separate portal, submit an additional information form to HMRC, and this has to be submitted before you file the tax return with the R&D claim in. And there is a separate portal to do that. Additionally, with effect from 1st of April 2023, you have a scheme of advance notification. And this is if you're new to claiming R&D tax relief or have had a gap of a few years, you have to tell HMRC in advance that you plan to claim R&D tax relief. That is again via another portal, and you only have 6 months till the end of the accounting period in which to notify HMRC. Otherwise, you won't be able to make an R&D tax relief claim for the year. So just be aware of these things. A little reminder there about what is an SME, fewer than 500 employees, and some turnover and balance sheet numbers. Just remember, you have to look above. It's not just the entity in itself, it is also the wider entity. So look above to who owns you, and you might have to bring in their numbers as well. What's the benefit? If you're a profit-making company, I've given you some metrics. The thing to realize that in brackets is the rates have gone down for the SME company. So it was a very generous relief and it is no longer as generous. You can surrender for cash if you're loss-making, and again, the rates have gone down. There is also, and I'll mention it here, the R&D intensive scheme that they've brought in. There's a third rate as well, but generally the rates have gone down. With the R&D expenditure credit, it's given slightly differently at the moment as a taxable credit, so it comes in as a grant that's taxable. It was 13% and now it's gone up to 20%. And the reason for this merging of the two schemes, so the SME scheme getting less generous and the RDEC scheme getting more generous, is the next slide, which is what is the new regime. And that is the new merge scheme coming into play, where everything, with except a few exceptions, will be what's called the above the line, like a grant, taxable credit of 20% of your qualifying expenditure. The big key changes to be aware of is there are very detailed rules now on subcontracting and who claims the R&D tax relief. And broadly, it's the top person at the top of the chain, the owner of the R&D. There are a few exceptions, but basically it's the top of the R&D chain, the owner of the R&D that will be able to claim. And there are some restrictions if you subcontract out, and these are new, and that is about subcontracting to overseas. So if the overseas activities are performed overseas instead of the UK, the relief may be restricted, if at all. There are exceptions for geographical reasons, such that you're doing research on a volcano that's only located overseas, for example, geographical, or regulatory, for example, clinical trials conducted overseas. And finally, a little point there that just for SMEs that are R&D intensive, they can still carry on under the old scheme. That is my whistle-stop tour on R&D tax relief. We do have the webinars if you want to look further, and there's a little timeline there. I'm not going to talk about it, but you will get that when we send you the slides at the end. Very swiftly, because patents have been mentioned, another attractive incentive is the UK patent box. And this is becoming more attractive as we enter the regime of 25% tax rate, because it is a reduced rate at 10% for profits derived from patents. It is a company-wide election. So once you are in the patent box, you make an election, and you've got 2 years after the accounting period end, you are in the patent box for forevermore. If you choose to come out, you can come out, but you can't go back in for another 5 years. So it's just worth planning your time to go into the patent box. Lots of conditions on the patent box. You have to be a qualifying company within the charge to corporation tax, and you must own what is called qualifying intellectual property, broadly patents or their equivalent, but it must be either a UK patent, one issued by the EU Patent Office, or one separately on a list of about 13 individual patent EU members. The calculations are quite complex, and a key thing is that you must link the R&D expenditure to the creation of the patent. So it's not appropriate just to buy a patent and hope that you will get in the patent box. You have to actively have developed the patent in some way, or the product incorporating the patent. And that is the last step of a 4-step calculation, which this concept diagram just shows you in brief. So the outer orange box is saying all my profits for the entire company. And what I do is basically split it into those profits which I've got selling patent items, say, and those which are not. So I've whittled it down. That's step 1. So the balance of all my non-patented sales will be taxed at 25%. Having whittled it down, the next step is to say, well, I will make some profits anyway, whether or not it had a patent. And HMRC have decreed that that's 10% on your normal costs. And that is known as the routine return. So that bit's stripped out. They then say, well, actually, if someone was buying a BMW off you, they would be paying an element of profit for the brand. So we'll further strip out a bit from your patent box profits, if you like, because all those bits will tax at the normal rate. And finally, you're left then with what is the patent box profit, and that is then multiplied by what's known as the R&D fraction, where you have to just map the R&D that you've undertaken, or qualifying R&D, linking back to your R&D tax relief on those patents or the invention. And you multiply that, and you arrive at the number that will then be taxed at 10%, with all the rest being taxed at the normal rate. Phew, I've made it. That, everyone, is a whistle-stop tour through some of the tax aspects. And we now have a few minutes left to see if there are any questions from anyone. So I will just have a look at the question and answer screen.
There is one here, Margaret, which I
Right.
can read out for you.
Okay. Thank you.
which is with regard to subcontracting to overseas, how are overseas subsidiaries classified for this purpose?
So can you repeat the question again? With
regard to subcontracting overseas
yes.
for R&D, how are overseas subsidiaries classified for this purpose?
It's an overseas subsidiary if the activity is performed overseas under the new rules. Then you would have to. The default rule is that you would not be able to include it in an R&D tax relief claim. However, there are exceptions if you have activities performed overseas, as I alluded to, which if it's for geographical reasons, and it's basically, it says, the legislation says there are conditions required to conduct your research overseas, for this subcontractor to conduct the research overseas, that only exist overseas, and it would be impossible or not reasonable to replicate in the UK. So, for example, my example of the volcano, if you were doing some R&D on seismology testing on Mount Etna, the only place you could do the work is out on Mount Etna. The other example, so that would fall in the exemption. The other example is regulatory. Say you're developing a drug that you want FDA approval, say, and you need to have clinical trials performed on a population of US subjects for that particular disease or category. Therefore, you have to subcontract to an American CRO, and therefore, again, the activity would have to be formed overseas. But you would have to retain the documentary supporting evidence to prove that you'd fall in one of those exemptions. The Revenue have now published detailed guidance. So they've published a guidance in the Corporate Intangible R&D Manual, the CURD manual, on all the new rules, and they have a detailed section on overseas, the new rules on overseas subcontracting, and I recommend people read that. They've also issued some draft guidance. It does get complex. Everybody's going to have to look at their own individual fact patterns in the light of these new rules.
Thank you, Margaret. I can see that somebody's got their hand up, but we can't. There's no way of us getting a question from you if you wanted to ask one, unless you put it into the Q&A function, which you'll find at the bottom of your screen. So if you wanted to ask that question, please do pop it in the Q&A. Thank you.
I've got one other question that's popped up, which was, where do you find double tax treaties? And the answer to that, it's very straightforward. If you Google double tax treaties, HMRC, it's on the hmrc.gov website. There is a long list alphabetically. So you just dial up the country that you're interested in looking at the double tax treaty, and you can find out what it exactly says. And typically they follow the OECD model double tax treaty format, and there's typically a section on things like interest, royalties, and what the withholding tax would be, and it can vary. So, for example, the double tax treaty between the UK and the USA takes royalties down to nil. With Australia, it goes down to 5%. So it is each case now. You have to look at each country's double tax treaty. Otherwise, the default is 20%. James, you seem to be on top of the quick Q&A more than I am. Can you see any others there for us?
I think that's all of them. So assuming that our raised hand person doesn't have a question via the Q&A, I think that we can finish 1 minute early.
Perfect.
But feel free to follow up with us.
Thank you very much. As you can see, we've got all our details up there on the screen. We hope you found this relevant and useful. Do please contact us separately. And as we mentioned before, this is only intended to be a whistle-stop tour. We hope you found some relevant things. Maybe something's resonated for you that you just think, oh, I'll go and look that up and find out a little more, or do feel free to contact any of us. The slides will be sent to you afterwards, so you've got them for your reference. And without further ado, thank you very much for coming on our webinar, and enjoy the rest of your afternoon. Thank you very much.